Okay, ladies and gentlemen, good afternoon again. A very warm welcome. And thank you again for joining the ACI's Asia Financial Markets Forum, the virtual prelude for 2021. Now, you're in the first breakout session forum of 3 breakout sessions. And in our breakout session, what we're going to do is we're going to discuss about the geopolitical chessboard for Asia. Now, specifically, this is, of course, a financial markets forum. So what we try to do is to tease out, the financial implications for the geopolitics. And of course, hopefully, we can present to you for your consideration some actionable investment items for your consideration. Now, before we start, I would like to quote President Joe Biden, the 46th POTUS of the United States. And at his inauguration speech just 2 nights ago, this is what he said to the rest of the world, quote, "The world is watching today. So here is my message to those beyond our borders. America has been tested and we have come out stronger for it. We will repair our alliances and engage with the world once again, not to meet yesterday's challenges, but today's and tomorrow's. We will lead not merely by the example of our power, but by the power of our example. And we will be a strong and trusted partner for peace, progress, and security." Unquote. So is that an olive branch to China, or is that a challenge? And if those of you who keep close tabs on what's happening out of the tickers out of Beijing, just the day before the inauguration ceremony, the state media teased an outline of the 3rd aircraft carrier for China, which is, of course, much bigger than the first 2. So how will geopolitics work out for our part of the world? Now, today, my name is Kun Hao. I'm from United Overseas Bank, and I'm very, very privileged and honored to be given this opportunity to moderate a very high-powered panel. Now, we have 4 esteemed, distinguished guests for today. Please allow me some time to introduce all 4 gentlemen. Now, first up, we have Mr. Cesar Purisima. Cesar needs no real introduction, of course. We know him as the former Secretary of Finance and Trade for the Philippines. Cesar is an Asian Fellow of the Milken Institute. He is also a founding partner at IKH LAS Capital, a pan-Asian private equity platform. Now, currently, Cesar serves on many corporate boards, the boards of the AIA Group, World Wildlife Fund Philippines, De La Salle University, Ayala Land, Universal Robina Corporation, Jollibee Foods that we're all familiar with, and of course the International School of Manila. Cesar is also a member of the Sumitomo Mitsui Banking Corporation's Global Advisory Council and the SMU's, as in the Singapore Management University's International Advisory Council in the Philippines. Now, given his very extensive government contributions and broad corporate experience, we are very eager to hear out his authoritative views on regional geopolitics. So that's Cesar Purisima, everybody. Next up, we have Professor Bernard Yeung. Prof. Yeung is the Stephen Riady Distinguished Professor in Finance and Strategic Management at the National University of Singapore Business School, where he was Dean from 2008 to 2019. Prof. Yeung is also President of the Asian Financial Bureau of Finance and Economic Research, and he was a recipient of the Public Administration Silver Medal in 2018 in Singapore, as well as a member of the Singapore Economic Strategies Committee in 2009. Prof. Yeung's research covers economics, finance, international business, and strategy. He was awarded the Irwin Outstanding Educator in 2013 from the Academy of Management and is an elected fellow of the Academy of International Business. So Prof. Yeung is the academic in our panel. He gives us the brains, and he will have very good in-depth understanding of how China's economy is transforming. And I look forward to Prof. Yeung to give us, a fundamental dissection of how the regional economic trends will change with the geopolitics. Third, we have Stephen Chang, who is currently the portfolio manager and chair of the Asia Pacific Portfolio Committee at PIMCO. He has been in the industry for over 20 years, and Stephen was previously an MD and head of Asian fixed income at JP Morgan Asset Management. We all own a bond fund at PIMCO. So I would like to hear straight from his mouth how Stephen positions our money and investments, across Asia. And finally, lastly but not least, is Mr. Adam J. Levinson. Adam is the founder, managing partner, and CIO of Gamma, and we know him very intimately in his role. Previously, Adam was a principal of Fortress, where he co-headed the liquids market business, founding Fortress Asian Macro Fund. He began his career, of course, at Goldman Sachs as a prop trader. Adam received his BA in government, magna cum laude, Phi Beta Kappa from Cornell, and has studied abroad at the London School of Economics and Political Science. So Adam is a very successful investor in his own rights, and he puts his money, where he says. I'm looking forward to his unfiltered and incisive thoughts. So, ladies and gentlemen, thank you again for joining us. Let's start the forum proper. You know how to type in your questions in the chat box, but I would like to kick off the first question to Cesar. Now, Cesar, we heard, Joe Biden's inauguration, right? Whether that's an olive branch or a challenge to China. Do you think the great US-China strategic rivalry is now over, has turned better? And specifically, for all of us in Asia, we are caught between two elephants. Do we still need to choose sides? So Cesar, if you can share with us your insights, please.
Thank you, Khun Hao. Good afternoon, everyone. Thank you for this opportunity to share my thoughts. President Trump handed Joe Biden a US-China relationship that I think is at its lowest point since the 79 or 72, when the relationship started. In fact, the latest Gallup poll says that 2/3 of Americans have an unfavorable view of China, which is the highest number ever. I think with the coming of the Biden administration, the big change, obvious change, will definitely be the form of the relationship will improve. The substance will take time to improve. So the form, it will be obviously less personality driven, less chaotic, less megaphone diplomacy, more traditional diplomacy. I think there will be more collaboration with allies rather than a go-it-alone approach. I think it will also involve working more with the multilaterals. In short, it will be less chaos, more strategically focused, more consistent, and more calculated. Having said that, unfortunately, China has been positioned in the US as the main strategic adversary of the US. And there is bipartisan unanimity on this issue. And being seen as soft to China will be politically costly for Biden. But Biden, mind you, sees China also as a real, genuine economic threat to the US. And containing China has been deliberately put as one of long-term policy for the US. Obviously, they compete not only in the field of the economic power, but also military power, technology, the direction of technology, geopolitical influence, and technological superiority. And there's a study or a thought that says that when there is a change in power or a second power threatening, the dominant power, the tendency is for them to end up in war. I think they refer to that as the Thucydides trap. But obviously, that's something that we don't want, especially ASEAN, because we're right at the center of this confrontation. So we want competition that will not result to confrontation. So how can that be? ASEAN, I think, can play a very important role in making this happen. As you know, ASEAN gets global leaders to meet in ASEAN every year at the minimum. So establishing this dialogue, especially now that you have a US leader that is more prone to traditional means, would be a very good start. Trump has missed the last 3 ASEAN summits. No? So what they can look for is to put all these disagreements to the side and look at areas of potential collaboration. And these are, for example, climate change, COVID-19, or even how to restart the economy. I think, with a calmer and less chaotic president of the US, no, then I think the temperature can be lowered. No? The fundamental differences will be there and it will be hard to resolve. But when we start collaborating on win-wins, no, then I think we can start gaining confidence on what two working together can achieve. I think the US will be better suited if, I don't think they will jump immediately into TPP, but they might. But I would suggest that they pursue bilateral agreements. For example, they have a phase one with Japan. I hope they complete that. No? So by doing so, they improve their positioning in terms of dealing with China. So they have to fix their Asia strategy so that then they can have better handle on how to manage China without having to end up in confrontation. On the part of ASEAN, we don't want to choose. We will work with both, but I think we can play the role of the venue, not just for confrontation, but a venue for people to agree on common interest.
Thank you, Cesar. And I hope somebody from the Biden administration logs in and listen to this right now, right? We from ASEAN do not want to choose side. We want to play the role, of the middleman, and we can assist, US and China to make things right, given that we have a change of guard here. So that's that big picture in terms of geopolitics. I want to move on now to Adam. And I think everybody has this big question. As what Cesar said earlier, the form may change a bit in the relationship, but not the substance, meaning that competition, that challenge is still there. And we all know in the background, Chinese firms still get blacklisted by the US. And of course, basically the sanctions are still in place. So if I can ask Adam very, very directly, how do you invest around all these things if you still believe China is the place to invest in?
Well, I actually think there are two parts of it. First, I think Cesar's outline is dead right. The rivalry is not going away. In fact, one of Trump's greatest successes was moving the debate such that it really is a political liability to be soft on China. But having said that, the implication of that change in attitude in the U.S. Is pretty clear with respect to China itself, and that is it forced China to aggressively adopt a strategy to indigenize a lot of development. And as long as, in my opinion, as long as you're actually investing along that policy vector, everything that is supportive of the dual circulation strategy by necessity, because China has just recognized that it needs to reduce its vulnerability on, let's call it, the prevailing institutions that govern the existing financial system, or what may become, in not too distant future, the legacy financial system, but for now, the existing financial system. And so that's led to an aggressive pursuit of the DCEP, China's digital, the sort of first large rollout of a digital currency. But whether it's the chip indigenization or certain shift in domestic technology incentives, that, in my opinion, will remain a pretty successful place to be over the next year or two. By the way, so too will defense contractors in China, because the buildup and the rivalry, will go on. The flip side is, from the U.S. perspective, I think that there's also a viable path to consider, and that is, I think for the first time in probably 3 to 4 generations, the U.S. will, I think, under the Biden administration, begin to have a formal industrial policy. And out of that, largely around reshoring or securing the supply chain, which will include investment, bringing things back into the U.S. You've seen that already with sort of incentives related to things like TSMC moving to build a large fab in Arizona, Samsung doubling its capacity in Texas, and so on. That's going to remain ongoing. But I think in that case also, ASEAN has a chance to benefit from shifts out of the pure China sphere into something that, at least for now, looks somewhat more neutral.
Thank you, Adam. Well, I think, okay, let's just, we keep talking about China, right? And there's always this myth about what China is doing with double circulation, 双循环, in terms of its economic policies. There has been a lot of skeptics. This question, I think, goes to Prof. Yeung. Prof. Yeung is probably best suited to answer this question. What do you think China has done right in its reforms in terms of how it's restructuring its economy, and what can we look forward to that's positive from these reforms for the geopolitics?
I think it would be very useful. First, thank you for having me in this panel. I am learning already a lot from my fellow panelists. It's an honor to be here. And I think it would be the best to look at this from an economic development and international economic cooperations perspective. Since the Xi Jinping regime, there has been a lot of discussions about China's rebalance, reform, restructuring, moving now to the dual circulation. People like to label all this, but if you think in a longer time horizon, you realize that China is really going through the natural state of progress in economic development. By the way, are you able to hear me properly, or?
Yes.
Okay.
Prof,
yeah.
You're
I
good.
just want to make sure the voice level is okay. So you think about what China has done is really moving from using labor-intensive light industries, export dependence, to relying on saving and investment, development, and now is striving towards having more comprehensive, inclusive growth. And the dual circulation is just a fancy word for balancing internal and external demand and utilizing internal and external resources based on sound economic principles, which is often labeled as comparative advantage. So what China has done is no big deal, is not surprising, and other countries in East Asia like Japan has gone through the same kind of thing. And China recognized that, and we all recognize that from 78 to now, it is really still work in progress. And so it's very rightly so for the leaders to label their actions in a way that can ring a bell for its citizens and for the users of its rhetorics. So let's look at the rebalance. Let me follow their agenda and look at what they have done. Let's start with rebalancing. And we noticed that in the past decade, the investment has dropped. Say, if you move from 2010 to now, the investment over GDP, take it as a dependence measure, has dropped 15% from 50.5% to 35%. The dependence on export has dropped by 10% from 28.5% to now 18%, while consumption has increased by 7%, moving from 48.5 to 5.5%. And the alleviation of people above the poverty line is 100 million. So you cannot say that China is not doing the rebalancing and is not promoting inclusive growth. It is. The second thing is that, as we are all in finance, we all understand that the capital market and all these rules and regulations allow us to be the CPU unit of resource allocation. This is important. And let's look at it. China has moved from controlling the interest rate floor and ceilings to relying on the LPR, the loan prime rate. And if that doesn't work very well, they change it and mark the loan prime rate together with the PBOC's medium-term lending facility rate. So it's now the banking system is now moving very much like the most modern banking. Well, most modern is an exaggeration, but is moving towards a modern banking system. And let's look at investment. The Chinese investment is now foreign financial institutions, foreign financial service companies now can have full ownership in China. And let's look at the bond market. We all worry that the Chinese bond market never has any default, and now they allow bankruptcy even for SOEs. All these are right moves. Think about the equity market. Yes, there's all this Alibaba thing, but if you think about it, it's about opening up the IPO market and so on and so forth. And even Bloomberg, if you go to the website, you can find a lot of stories about what they do, what China is doing in improving the regulations and liberalizing its capital market. So it depends on whether you look at this from the glass is half full or half empty perspective. And I think geopolitical issues mask our understanding and bias our reading of what China has been doing. I think there's geopolitical issues just for the purpose of it. They have to create misinformation. They have to create disinformation. They have to bias information. I mean, on both sides. Both sides may be telling lies and whatnot, but it doesn't matter. We are investors, and we put money on the table, and we read what's going on. And the fact is important. The economic environment is important. China is work in progress, is not perfect, but has been making a lot of improvement that the mass media may not carry as headlines, but we notice the changes. And let's think about what happens. I think in a way, in the 21st century, people say it's the Asia century, and I think it may be, it really may be. You think about Asian countries, we have a huge middle class coming up. Our population is 667 million altogether. And this is a big market with growth potential. And if you just give this market another 10%, it's a lot of money. And give it 20%, and if you're the investor, you look at this long-term trend. Then let's look at what's happening. Because of all this geopolitics and so on, actually this market has become more integrated. Indeed. Foreign direct investment in Asia, while around the world is contracting, has increased by 13.4%. Sorry, let me repeat. The world's FDI in 2018 contracted by 13.4%, but in Asia increased by 6.3%. It went against and better. And then for the same thing with the trade, the intra-Asia trade has gone up in 2008 when everyone's trade is going down. If you are a business person, you're going to configure your activities according to where the market is, where the resources are. You want to control costs, you want to control transportation costs, and you want to mitigate risk. So it's to me, Asia is really developing into an integrated economic system to capture its growth potential. It's not, there's a long way to go, but business is about investing in the developing future. We should be excited about it. And so lo and behold, we are excited to see that things like RCEP all are coming up because the world know that we need to have cooperation. And I think this is the desire by all the people, not just by one or two politicians. So in conclusion, my intervention is that the long-term historical trend are all being followed. And China is doing what it should be doing. And we should look into the details and appreciate what it's doing. And also business can help China to do better. And we all together, the investors and the actual business people, et cetera, can help us to generate this integrated Asia co-development system to give us inclusive growth and also prosperity for as wide a population as possible. And that's the only way to go, I think.
Thank you, Prof. And I do agree with you because we jump every day on the geopolitical news about, all the sensitivity. but if you follow the economic development, the fundamentals, Asia is the place to invest in. So Stephen, now this question to you.
So that's exactly why, in spite of the newspaper headline, business people are investing here.
Yes. So Stephen, how do you invest around, all these China themes that Prof. Yeung has been talking about? How do we benefit from that if you remove away the geopolitics?
Well, I certainly am more in the glass half full and more optimistic camp that Prof. Yeung has just described. And if you look at not only 2020 in terms of GDP growth being positive around 2% for China, this year ourselves and I would say the consensus is expecting 7, even up to 8, 9% growth for China. So economy will continue to rebound very strongly. And so there are lots of good investment to be had when you had a system growth in that magnitude. And in turn, for me, more in terms of a bond investor, that's also helping with the corporate fundamental. And we have actually, as a house, increased quite a lot of investment into Asia credit, China high yield, and a number of sectors that we think will continue to enjoy this secular headwind of growth in China and across in Asia. Now, more about the risk that you asked about, Kun Hao. For this year, because they are going to have this growth, I think what the objective would be is to more control the risk and to take this chance to make things more sustainable. And the 3 tough battles that have been in force over the last couple of years, one of them is to control the systemic risk. The other 2, I think we kind of touch on a little bit in terms of the poverty and some of the environmental issue. So in terms of this risk for the system, the more near-term one is on the credit to GDP ratio, and that has actually grown quite a lot. Even last year, but over the last 10 years, it has accumulated to a point where a lot of people are arguing whether that would be sustainable. It is arguably a more developed market phenomenon more broadly, but for China, I think they're going to do something about it. We have seen new guidelines, red line for property-related type of measures to control that growth. But more broadly, as a system, we also see the shadow banking side and the property and other, perhaps the more investment-intensive, capital-intensive area will also be very highly monitored to a point where we would expect net new credit growth in China will be lower. So the credit impulse, which is that measure, will go from a very positive in 2020 to a more negative level in 2021. And that would have some growth implication also across as perhaps going into the second half of this year. And there might be sectors that are more dependent upon the demand from China to see that fallback after that big growth late last year and early into this year. So that, I think, is more about the internal risk, about how to keep that growth sustainable and how to control the debt. And then the second element that I want to bring is the external risk. We had earlier talk already quite a lot about the China-US relation. And we have also done a lot of study from our annual secular forum at PIMCO to think about these in terms of 4 pillars. So those would be the tech element, which has been well telegraphed through many of these Huawei-related sanctions, certain entities not able to get U.S. components. So that might still continue. I think that's still part of the Biden administration kind of focused area. The second one, which also has been very highly telegraphed, is the trade element. So the Phase 1 trade deal was touted as something of an accomplishment. And that, whether that would be unwound or not to us is also something we'll monitor very closely with the trade part still very much in Biden's mind in terms of the domestic focus. I think there needs to be a domestic element from the constituents that he needs to answer to, and trade and onshoring that we described earlier will still be something that would be harder to be unwound in the near term. So tariff has gone from 3% to 19% on average through this last 4 years. And would it be coming down? Potentially, but I don't think it's going back down to 3, maybe not even go back to 10. And we also look at the financial side. There has been some executive orders coming through from Trump since November to block certain, to block U.S. persons from investing in many companies. And for us at the as a investment manager or across the financial industry and intermediaries, that has been something that we need to find out more answers about what the new administration wants to do. To us, we see a bit more of a pause in that continuing. Maybe some of the existing one will take some time, or maybe use as a bargaining chip to get other things for what Biden might be ultimately wanted to get to. But I think these sanctions will be less of a tail risk for the financial market. And so those are the key elements, I think, from our standpoint, where some of the risk lies. And then geopolitical or military wise, that's also something which might also be less of a tail risk as well. That's sort of the fourth pillar that we're thinking about. And agreeing with some of the statement from earlier, where we see Biden to be more methodical, more multilateral, less unpredictable, and they'll be more fact-based and more thoughtful.
Thank you, Stephen. And I hope everybody is taking notes, the 4 pillars in terms of what Stephen has introduced to all of us. Cesar, I want to move the conversation out of China into ASEAN now. Specifically, you said earlier about RCEP, right? About ASEAN being able to play a good role. Now, we all know how RCEP is touted as the new export or growth engine for ASEAN. My very direct question to you is RCEP the real thing? Will it really bring real trade benefits into ASEAN? I mean, how do you see the benefits playing out for ASEAN from RCEP?
One thing we must remember in our part of the world, you cannot move out of China's orbit. So even if we just focus on ASEAN or RCEP, we're going to be talking about China. And the good thing is ASEAN now is China's #1 trading partner. And China is our #1 trading partner. And it makes sense because we're geographically adjacent to each other, no? Just like Mexico or Canada is to the US. RCEP is the world's largest trade agreement. It's even bigger than the EU 28 or NAFTA. It covers about 30% of the world's GDP and trade. So the good thing is it's really not about lowering tariffs, because for ASEAN, it has many free trade agreements already with China, with Japan, with Australia, New Zealand, with almost everyone in RCEP. It's about moving it to another stage, lifting non-tariff barriers, setting rules on movement of people, protecting investors from each other's countries, setting rules on e-commerce. So as China, I think someone mentioned earlier about China becoming more of a consuming country. I think the US right now is the world's consumer of last resort, but it will become China. And it's and when China becomes the consumer of last resort, that is really when the gains to us will accrue. In fact, a lot of our trade right now is really as part of global value chains. Now, these are mainly intermediate products. Even with ASEAN, our intra-ASEAN trade is about 25%. Our goal is really to shift that from intermediate products to final consumption goods. In fact, there was an estimate that if we're able to move that to 40%, EU is around 60-some percent. That's another $1 trillion of economic activity. So RCEP, where all 10 ASEAN countries are part of, is expanding the opportunity for ASEAN. It gives us additional market access. But more than that, it helps it become part of a very large area, especially in the setting of the rules of digital trade, of e-commerce. And in fact, this is where the US will lose out if they do not come back to Asia. They will, in effect, default to China to set the rules on e-commerce, the rules on the green economy. That's why I believe it is incumbent upon the U.S. If they're not rejoining PPP, they must engage bilaterally. So they must engage Japan, they must engage ASEAN, they must engage everyone, so that then they can reestablish their presence here. And it's to our advantage in ASEAN, because China is too big for us to deal with on our own. We need a counterweight to China. India is not yet ready. The natural counterweight is the US. And therefore, we really need to pull in Biden back to our next summit meeting in November and make sure that he attends and that we have a heart-to-heart discussion with him. And since he was part of the Obama administration, we must remind him of the Asia pivot of Obama, that he must see that through, and that the Trump administration was a hiccup, no? And we can get silver linings from it. It was mentioned earlier that he was the only one with the guts to bring it up in the open, the things that needed to be addressed. No? But if we are to make the China Sea a sea of prosperity rather than a sea of confrontation, ASEAN must play a role in centrality in discussing the common interests in the areas to move forward. And we cannot just deal with China. We have to bring in the US. And that's, we're destined to play that role. We must not choose. We must be the convener.
Thank you, Cesar. And I think what you said, kind of struck a new tone to everything, because we all thought that the US is the consumer of last resort and China is the consumer of last resort. And now, we need to basically work with China and the US together. I want to move on to Adam now. Adam, I think you have a fan out there. I'm not sure whether that's he or she asking whether you sleep better at night investing in China now. We all know that, what keeps you awake at night is, as what Cesar says, that digital push from China out into Asia. And a lot of people have been talking, is the geopolitical conflict, now that trade is stabilized, is the geopolitical conflict moving on to the digital front, specifically the central bank digital currencies or the e-renminbi? Your thoughts about this, given that this is something that keeps you awake at night?
Yeah, I think there are several questions in there, so I'll do my best to address them. With respect to sleeping better at night, the truth is, my answer is not particularly, just for the simple reason that I thought last year the perceived risk of confrontation or hostility was too high, given the fact that China had sort of moved on from it and had in sort of pursuing indigenization, that made China necessarily less vulnerable anyway, but the markets were sort of ascribing too high a degree of vulnerability to any sort of Trump mercurial action. Now, the situation is such that people are probably actually a little too complacent. Not to say that I really think that differently than what's been said earlier. I think the form of how the Biden administration will prosecute the strategy will be different. That'll generally be more positive. Specifically, actually, I think there's one big positive in the first half of the year to come, and that'll be that I think that you'll see the Biden administration as an olive branch actually release or drop the case against Meng and Huawei, in the first 5 or 6 months of the year. But that's probably the peak of benevolence, if you will, and there will be hostilities going forward, because as you note, the rivalry again is just moving to a different format. And so in the digital domain, I think that there are two things to consider. First is, yes, that is going to be a space where the battle, a new battle is going to be fought, and that's largely because the U.S. controls, as we all know, in the global payment system, it frankly controls way too much of the current financial architecture, and China, to protect itself in the future, is trying to create a competing standard. That will draw a response from the U.S. I think you actually will see the U.S. Move to introduce its own digital currency much faster than people think, probably in the first 2 years, probably 2 years out. But you'll see, I think Gensler, you'll see Janet Yellen, you'll see the Fed take that up. They've been doing a lot of research on it already in response to feeling behind vis-a-vis China, and they understand that's an area of competition. And then with respect to ASEAN and where ASEAN falls in this sort of digital conflict, if you will, I think it's unclear. But one thing that some of us are talking about that I think is worth considering is this notion of so-called digital decolonization. That actually these markets, particularly like the likes of Indonesia or the Philippines, large markets need to have digital domestic champions and actually push back both the U.S. and China, because those markets are there's too much value there, and a lot of that value is being pushed into foreign markets, either with tie-ups or being buyouts from Chinese entities or the U.S. entities. And I think you're going to see a pushback against that in favor of digital national champions throughout ASEAN.
Thank you, Adam. So, this is an interesting arc, meaning, we locally must build our digital champions. I think you hear that a lot, and I hope, this drives in the point. I want to move the conversation into the other half of that rivalry. We talked a lot about China, about the region. Prof. Yeung, we want to move the conversation back to the US. I know you have done a lot of studies about the US economy, specifically what is wrong with it and what's not going well with it. I think let's be candid to the audience here. We've talked a lot about, what's bad in China and the region, but what do we need to worry about in the US, the other side of the fence now?
Well, actually, before I moved to Singapore, I taught in the US university for 30-some years. I think it would be useful, again, to look into the history and the current and project into the future. When Donald Trump was elected in 2016, the US was having an all-time high income disparity. And then I think in Trump's regime, he created even more divide. The US internal division will still be there. It will be a stress point that President Biden would have to work on this. At the same time, this COVID thing, I think actually aggravate income disparity. Then with that as a background, we also recognize that the COVID has slowed down US growth. I think in 2020, the rate is minus 2.4%. We expect that it will come back, but it will take about 2 years to get back to the starting point at the beginning of 2020. So that is the backdrop. And in this period, besides dealing with the income divide, we have to think about what has happened to the fiscal picture. The US is having an all-time high government debt. Its current government debt is $27 trillion US dollar. And its federal government budget deficit is 3.13 trillion. So all this, by the way, the interest expenses, even at the very low interest rate and so on, is about 600 billion. So all this are really stressing the system. In trying to recover, the fiscal chest is getting emptier and emptier. At the same time, inflation already, there's warning by, for example, Bill Dudley that says that there are 5 worries about the inflation is coming. You think about this, what we have is that there is a lot of pent-up consumption. Once people can come out, you can see that they line up and they will do a lot of consumption. But supply is still relatively inelastic. and the government is still pumping the fiscal subsidies and so on and so forth. So you do have to worry, and you do have to worry about inflation will edge up. And at this point, I think the U.S. is in a bind. The Federal Reserve will have to accommodate any restraint in the money supply will have a negative effect on the recovery. And the budget deficit and debt, people may have to worry about raising taxes, but that will also put the U.S. government in a bind, because that may also adversely affect the recovery. I think this, and also if we dig into it, when we look into economic history, we'll find out that the policies in the past 4 years may be negative on the long term on the U.S. economic efficiency. When you put all this together, I think there exists good reasons to be nervous. At the same time, the silver lining is the following: enough is enough. There are enough people talking about this kind of thing, and I think the politicians, the leaders, are aware of all this. And at the end of the day, we know that continuous escalation of conflict is not going to help, and we do need cooperation. So that's one point that I feel there will be a switch in attitude. It will not be overnight, but there will be a switch. And the second thing is that I think there's a blessing in disguise in this pandemic. It mutes a lot of the resistance in using technology, and there may be a return of productivity growth, and that can solve a lot of problems. Currently, the concern is the U.S. growth is slow. There's not much room for raising taxes, and you have to accommodate itching up inflation. The way to deal with this is that we regenerate productivity growth, and that calls for economic cooperation, and that also calls for really trying to take advantage of the technology more.
Thank you, Prof. So I think we all worry about the deficits, the potential inflation, but on the other hand, there's a balance of upcoming productivity as well. So, hopefully things will balance out for the US. Stephen, there's time for one last question in our forum, and I'll just package the remaining few investment questions for you, if you don't mind. First is, of course, any particular space in ASEAN that you position in, and the second one is, what about the Chinese companies? Will they continue to see the threat of delisting? These are the two latest questions from the audience.
Well, thank you for those questions. And for me, on the ASEAN side, there are some country-specific type of movement. But from a more macro theme standpoint, our view is growth will rebound this year, partly because of the very low base effect, but also because of the general monetary stimulus and fiscal stimulus in the global monetary space, which would seek income and seek investment opportunities. The background of this, if you look at U.S. real yield through the tips, it's around -1%. If you can look at the real yield and what kind of actual nominal growth or real growth you can see delivered, even though it's just 1 year time frame, you could easily see 8% in China. Some economists are predicting 7% growth in U.S. GDP in 2021. So that momentum will continue, and for us on a fixed income side, EM markets will do better and would attract inflow for those markets with higher yielding nature. And in the Asia context would be Indonesia and India that would attract these type of investor into it. While there are drawbacks, there are some worried about sovereign ratings potentially because of the fiscal deficits they need to run given the pandemic. But I think those could not be kind of the biggest block for people to add exposure in anticipation of recovery later on. India in particular, for the FX side, they have been building up a lot of reserve. They have seen their current account come back to a surplus, and you still see portfolio inflows into it. So I think that's kind of where the market hasn't really priced in a potential change in terms of that reserve accumulation behavior from the RBI. And on that other question about delisting, that's a very interesting topic. I saw overnight the headline about those 3 Chinese telecom companies applying to get reviewed, whether they can be relisted or not delisted by the New York Stock Exchange. I think there are a lot of rules to be clarified by the Treasury and by the OFAC department particularly. There has been a lot of confusion in the financial market interpreting that. But as I said, I think this is more of a legacy from the executive order from the Trump administration. The financial market and having U.S. as a kind of central and a globally accepted marketplace is going to be more important, I think, from the U.S. standpoint under the Biden administration.
So let's hope cool heads prevail and they're a bit more objective in the new Biden administration now. Okay, so we're coming to the end of our forum. I'm going to throw a fun curveball to all 4 gentlemen of you to end this up. If we are able to secure an audience with Joe Biden, right? What is the question they're going to ask him, when we do see him? So quickly, can we go to Cesar, please? What do you tell Joe Biden?
Well, to invest in the U.S., a more confident U.S. Will be a more level-headed U.S. So he has to invest in U.S. infrastructure, improve U.S. productivity, invest in education of Americans so that they can reestablish their lead and their superiority over the rest of the world. Because an insecure U.S. is not what we want, and that can lead us to what we're worried about, that Thucydides trap.
So in other words, as what Janet Yellen says, he has to spend big for the U.S., right?
He has to have a market plan to reinvigorate the U.S. from all dimensions in terms of education, technology, infrastructure, processes. Make a big leap from current technology to a more digital and more green economy.
Okay. Adam, what do you tell Joe Biden?
2 things. Cesar's right. You're only gonna get one thing done legislatively, number 1, and he knows that. And so that's got to be infrastructure. But on the digital side, he can do that through regulation. But basically, if the U.S. wants to be a winner in digital, it needs to come up with a coherent regulatory leadership framework around crypto and understand that digital assets and crypto are going to be the basis of ESG in establishing provenance. And so this expands much more than just the commodity nature of what crypto and the blockchain is. But the U.S. needs to lead on that and can do so without legislation.
Okay. And Prof. Yeung, what do you tell Joe Biden?
Continue to restore rationality. I think both the US and China can benefit a lot by having mutual appreciation. The Americans benefit a lot from China's savings and low-cost production. At the same time, China benefit a lot from the US pushing for market reforms and learning from the US technologies and so on. Both sides are learning a lot. They should be friends instead of enemies. And there's a Chinese saying, confrontations hurt while harmony will allow us to share prosperity. Then the second thing I want to say is that having been in the US for so long, and my kids were raised in the US system, I think there exists really some internal issues in the US. The US problem is a lot more internal than external. The US income disparity and all this is really because that it has some internal problem that we have to deal with, including education, etc., etc. So 2 points. Restore rationality and conduct mutual appreciation instead of misinformation. Second, address the internal problem. The US problem is not out from outside, but from inside.
So as what Prof. Yeung says, 和气生财. So we need to work together for the prosperity of the US, China, and the region. So Stephen, off to you. What will you tell Joe Biden?
Well, I would probably still focus much more on this China-US. It doesn't have to be kind of a confrontational rivalry. I think similar theme as Prof. Yeung. It has been viewed as more of a zero-sum or even a lose-lose situation that Trump has created. So we'll try to persuade him that it could be a win-win situation and focus on strategic cooperation area. And also want to see and check with him, what kind of theme he wants to drive. We can talk about specific policy on one part or another, but he hasn't built up a theme like a MAGA or Make America Great Again type of thing. I think it's something like Build Back Better, but it doesn't roll off the tongue just as strongly. But we'll see what he come up, if anything, on that more thematic in terms
maybe
of
MACA, Make America Courteous Again. So let's see. So thank you, gentlemen, for all your insights, and thank you, our dear audience, for listening in. We've come to the end of the first session. I hope you got, all the snippets from all of us. Thank you, Cesar. Thank you, Adam. Thank you, Prof. Yeung. Thank you, Stephen. And do stay on. Do join the second panel, which is on the future of business and banking. And of course, Adam has given snippets of that in the next two panels. There's ESG as well. There's digital discussion. So do join on for this important topics of the day. So from the first panel on geopolitics, we sign on off now, and we're just going to head off down to the park for a drink now. Thank you very much. Thank you, everybody.
Thank you.